let's say 35%, you're going to get a tax credit for those foreign taxes paid, and so you're going to pay the difference to the U.S. Okay, so in effect, after you repatriate, you're going to pay the full U.S. rate. Okay, so that's the worldwide system, as opposed to a territorial system where you would pay taxes in the country that you're operating, and then you're done. You can do whatever you want with that money. You don't have to pay any taxes in the U.S. Okay, so that was a major change of the tax bill. One of the major changes. I say it's approximate because they impose some rules about global minimum tax and other complications. But for our purposes, I'm going to focus on just a purely territorial system. Okay, so leading up to the tax reform, there's a lot of discussion about corporate taxes in an international setting. And keep in mind that we're focusing on foreign profits because this worldwide tax system affects just foreign operations. It doesn't affect the taxes that you're paying on your U.S. profits, okay? And to give you a sense of how large this market is, U.S. multinationals invest and generate a lot of profits and revenue overseas, okay? So in 2015, U.S. multinationals generated $7 trillion in revenue overseas. Okay, so it's a big number, it's a big market. Okay. Now there was a lot of discussion about how the U.S. should tax the foreign operations of U.S. multinationals, and there's a lot of different avenues. And in the political environment, of course, these things get muddled and confused. But one of the big ones was about foreign competitiveness. So our U.S. companies are being taxed on their foreign operations in the U.S., whereas other multinationals from other countries are not facing that same tax rate. They operate in a foreign country, they're taxed at the local level, and they don't have to pay any additional taxes. That makes U.S. firms less competitive when operating overseas relative to other foreign companies. Okay? There's also this big discussion about this trapped cash. Okay? So this idea that if you generate foreign profits, you might have a strong incentive to not repatriate and just hold those profits overseas and generate returns by investing in financial assets. Okay, so the classic examples of Apple, Microsoft, they held billions of dollars in foreign profits. They didn't want to repatriate them because they would have to pay U.S. taxes on those foreign profits. Okay, so this idea, I'm going to misuse the term cash over and over here. I'm going to call this cash, but what I mean is investments in financial assets. You can think of, say, U.S. treasuries or corporate bonds. Okay, so what is that cash doing? Is it distorting the investment of firms? Is it causing distortions in allocation of capital? Okay, so that was a couple of the big motivations for the reform. Okay, all right. So what are we doing here? Well, so we're going to ask the question. So how does this reform? And we're going to mold this around this specific act, but of course our model can tell us a lot of different reforms and the potential effects. How does it affect the U.S. multinationals' incentive to invest overseas? Okay, so these are the change in how profits are taxed overseas. Okay, so what are we going to do? So we build a model of the foreign subsidiary of a U.S. multinational. Okay, we're going to then calibrate this to subsidiary level data that we have from the BEA. Okay, so this is disaggregated, or sorry, this is not consolidated like you would see in CompuStat, but we actually get to see what foreign subsidiaries of U.S. multinationals are doing. Okay, so we can calibrate this to get some quantities. Okay, then we can do counterfactual experiments within the model. For example, what happens if, say, the TCJA passes? Okay, if we move from a worldwide to a territorial system, we can adjust tax rates, we can adjust how foreign profits are taxed. What distortions does that cause from this reform? Okay, so we're going to look specifically, our main focus is going to be on foreign investment. So how does the investment policy change? But along with that, we'll see how changes in output and productivity occur along with that. Okay, and we can look, within sort of the median firm, we can look across different firms. Okay. Now, we're also going to spend some time looking at, we're gonna allow the manager to make investment decisions, and that poses a challenge in terms of agency conflicts. So we're gonna allow for conflicts between managers and shareholders. Now, the reason for this, which I'll get into in a bit, is that in the literature there's been some discussion of, these large foreign cash holdings by U.S. multinationals, is that creating this a problem in terms of managers having access to a bunch of cash that's at their discretion? Okay, so that may create a situation where we have exacerbated agency problems and potential misuse of that cash. Okay, so we're going to allow for that in the model and see what effect that has. Okay, so and then we can also quantify this. What are the tax effects? How do taxes distort the investment decisions, and as well as the agency? So we're going to be able to quantify those things. Okay, so to walk you through the basic trade-offs in the model that are happening. Okay, so think under the worldwide system. So before the reform. So foreign profits are taxed in the U.S. when they're repatriated. Okay, what does that do? You're a U.S. multinational. When you're making foreign investment decisions, well, one, you expect to face a high expected tax rate on those foreign profits because you know you're going to at some point have to pay some repatriation costs. Okay, so all else equal, that's going to make the returns lower, and so you're going to reduce your foreign investment. Okay, that's what we'll call this direct tax channel. Okay, higher taxes, lower investment. Now there's another effect here that's going on. It's going to turn out to be dominant. Okay, in that the opportunity costs are going to change because of these repatriation costs. Okay, as well as the deferral option. Okay, so there are two possibilities. So one is that you immediately repatriate. That means you're going to pay U.S. taxes right away. And that's very costly. Okay, so that the opportunity costs of investment are lower. Alternatively, you can defer repatriation. Okay, but there are costs associated with that as well. In particular, you have to pay U.S. taxes on any passive income. That means returns on those bonds you're holding are going to be taxed in the U.S. That is costly. And so either way, it's going to lower the opportunity costs of foreign investment. It's going to make capital look cheap for foreign investment. Okay, so this is our cost of capital or opportunity cost of capital channel. It's going to go the other way. It's going to make foreign investment look relatively cheap. Okay, and you know this is one of the big things that was talked about is that Apple had something like $250 billion in unrepatriated foreign profits. Okay, does the fact that they have this cash that is somewhat costly to hold, and they would have to pay to repatriate, as well as they're unable to use it for investment in the U.S., does that encourage them to invest overseas? Okay, and this we say the answer is yes, and we show under very mild conditions in a very simple framework that this cost of capital channel is going to dominate, and so firms are going to invest more under the worldwide system, and so after the reform, we predict lower foreign investment going forward. Okay. Okay. All right. So, all right. So let me just give you a brief summary of the results. So we under the calibration in our quantitative model, we find that we sort of predict that the TCJA will lower foreign investment of U.S. multinationals by about 10%. Okay, so if you think about the steady state capital stock, we show that there's a lot of variation across firms. Okay, so it depends on the tax rates and other parameters of the model, of course. For example, goods producers have a larger response to this tax reform than service firms. We also show that the sensitivity of this reform in terms of changes in investment is going to be very sensitive to the firm's expectations about what the reform will look like. We also look at the role of agency, and we show it's not that large. Okay, so quantitatively it's relatively small under sort of reasonable parameter values. We're not necessarily surprised by this, but it doesn't seem large. We do show, however, that under certain cases, under certain compensation contracts, this effect can be large, but sort of on average, it's not huge. Okay, and the last point I want to emphasize here is that we show that this should not be necessarily surprising to anyone. U.S. multinationals are not very financially constrained. Okay, and the fact that we show this in the data that 83% using traditional measures are the least financially constrained firms in the economy. Okay, what does that mean? that means that having access to this foreign unrepatriated cash is unlikely to spur U.S. investment. Okay, it's not constraining for U.S. parents, and so the reform allowing firms to bring back unrepatriated profits at is not going to have this large effect on U.S. investments. That's should seem relatively reasonable. Okay. Okay, so I want to walk through. In the paper, there's an illustrative model to get through the basic ideas, and then we have a full dynamic model. I don't have time to go through the full dynamic model, so I'll try to walk through the basic illustrative model to give you the basic trade-offs that are happening. Okay. All right. So we have a model of a foreign subsidiary. Okay. Now within this model, we're assuming that there's some probability that reform occurs. Okay. So we're embedding that expectation. At the initial time, you're going to make all your cash holdings, repatriation decisions, and investment decisions. Okay. And if you repatriate, then you're going to face the U.S. tax rate here. Now at time cap t, there's going to be, you're going to produce, you have to generate your output. There's some probability that tax reform occurred, and so the tax rate that you might face on repatriation may change, and then you pay a final dividend and the game is over. Okay. Now, the important thing here is that the repatriation tax rate that you face at time cap t, this tau r, in expectation it's lower than the current rate. Okay, which I think is fairly reasonable. That's the case we focus on. There's some chance you get some holiday on your repatriation rate, making it potentially attractive to defer repatriation. Okay. Okay. So what is the subsidiary doing? So they have initial earnings. And they pay their foreign taxes on that immediately, and then they have this option of what to do with these earnings. So they can immediately repatriate, pay the U.S. rate, get some before they have to pay or they receive some credit for foreign taxes paid. They can hold this cash. Again, think of it as sort of relatively low risk financial assets. They get some return, and that's going to be taxed at the U.S. rate. All right, and the U.S. tax code specifies that passive income, so investments in financial assets, are taxed immediately at the U.S. rate. You don't have this option to defer repatriation. Okay, you can also defer repatriation by investing in foreign capital. Okay, so that's your other option, to invest, or you hold cash or repatriate. Okay, we're going to allow the U.S. parent to be financially constrained. This is not that interesting, but we sort of allow the value of those dividends paid to the U.S. parent to exceed 1, and if the U.S. parent is sort of values those investment opportunities in the U.S. and can't raise capital in the U.S. Okay. Okay. So after you've chosen your cash and capital, your after-tax value is here. This is after you've paid all the foreign and U.S. Taxes on your earnings. So this is the repatriation costs right here. Okay. So what's So the value of the foreign subsidiary, we have this piece that anything you repatriate immediately, as well as if you defer any interest and cash, as well as the output that you produce in the next period. Okay. Okay. So the nice thing here is that we have this. We can show the decision rule for when you repatriate. Essentially, we have on the left-hand side here with immediate repatriation, the value that you get from repatriation exceeds this deferral amount, the expected value that you get from deferring and repatriating in the next period. Okay. All right. So what does this look like? Okay. So when we can do comparative static in terms of investment, cash and dividends as a function of the U.S. tax rate. And one of the interesting things here is that because this U.S. tax rate is determining the opportunity costs of foreign investment, you actually get an increase in investment with the U.S. tax rate. Okay, so you raise the U.S. tax rate, suddenly foreign investment looks relatively more attractive, whether you're repatriating or deferring, and so you actually get higher levels of foreign investment. Okay, and again, this is coming through this opportunity cost channel. Okay, now of course the value is going down, so higher U.S. tax rate the expected present value of those foreign operations are declining as your expected rate increases, but you're choosing to invest more. Okay. And if you look at under a sort of a standard setting, which is a territorial system, you get the opposite relationship as you would expect. So as you increase the tax rate that the operations are facing, you invest less. Okay, so it goes in the standard direction. So this is under the territorial system. Okay, so I've already discussed these two competing effects. So I will jump ahead to the results from the full model. All right, so we extend this model to be fully dynamic. And we include sort of the parameter values that are guided by the TCJA. And as I said, we have this data that we're able to match moments on this foreign subsidiary. In the interest of time, I won't get into too many of these details. So we end up with the parameter values. Some of these are chosen to match, many of these chosen either to match directly tax moments in the data or the profitability investment rates of the foreign subsidiary. And again, this BA data allows us to look under the hood at the subsidiary level financials. Okay? So the model does very well in matching those moments, and then we can predict the response to this TCJA. Okay, so what do we have? So the headline number. So the capital stock, we expect foreign investment to drop by about 9.7%, or the capital stock to drop in steady state about 9.7% following this territorial tax reform. Of course, then the marginal product capital increases. We can look at things like global tax revenue. We're no longer collecting taxes in the US on these profits. We can also look at alternative tax reforms. Okay, so for example, what if we lowered the US tax rate but kept the worldwide system in place? Okay, it turns out that has a fairly similar quantitative effect because of different channels. Okay, or we can look at, say, not allowing deferral. So you don't have to. You can force the company to pay US taxes immediately on foreign profits and not allow them to defer. And we see that has a much larger effect on the distortion. Okay, as I mentioned before, this looks different across different types of firms, goods producers versus service firms. These firms face very different tax rates, and therefore the response is quite different. Okay, I also mentioned we can look at differences in expectations. So it's very important what firms expected the reform in terms of both tax rates and the likelihood. So Lambda guides the likelihood of reform. The tau R-K are the repatriation tax rate forced under the reform. So the response to the capital stock is very different depending on what the expectations are. Okay, and then finally, I'm basically out of time, but just to mention agency conflicts. So we quantitatively show that the agency conflicts don't have a huge effect on this distortion. They don't change the distortion very much. So relative to the benchmark, if we shut down agency conflicts, our estimates look pretty much the same. Okay. If we look at different channels, so for certain types of firms, for example, managers that have very little equity compensation, then we see a much larger distortion and a larger response expected from the reform. Okay. We also show that the sensitivity of investment to different types of incentive conflicts vary before and after the reform. Okay, so in other words, the optimal contract is going to change after the reform because the incentives are different. Okay, so to wrap up, so we show that we expect that following this tax reform, because of worldwide taxation moving to a territorial system, we expect lower foreign investments in a steady state in foreign operations of existing US multinationals. Okay, and that we shouldn't expect this tax reform, even though it allows access by US companies to their foreign unrepatriated profits, we shouldn't expect that to spur much US investment because we show that they're not very financially constrained. Okay, and agency conflicts don't look huge, and we need to think a lot about what what expectations about tax policy have in terms of corporate decisions. Okay, they seem to be quite significant. Okay. All right, thank you.